Well, welcome everybody, and thanks for tuning in to our Insights from a Thought Leader broadcast. I'm Jake DeKinder, Head of Client Communication at Dimensional. Incredibly pleased to be joined by Professor John Cochrane, Senior Fellow at the Hoover Institute, and I'll say friend of the firm. We've had John on multiple broadcasts before. He always does a great job, and I'm excited to get into all of the topics that we're going to cover today. A couple logistical items before we dive in. As always, you got the ability to submit questions. I got some great ones ahead of time. We'll cover those. I'll get to as many of the live ones here on the laptop as I can. Obviously, if we don't have a chance to get to every single one, either someone from Dimensional or potentially even Professor Cochrane will follow up with you. This broadcast is available for CE credit. The way the CE process is going to work now is once we finish the broadcast, you need to stay on at the end. There'll be a short quiz. We want to make sure you get your CE credit. So for those of you that want it, don't log out. Make sure you answer those questions. And before we get started, just want to say happy Veterans Day, and certainly thinking of all of those that served in the U.S. or are serving in the U.S. Armed Forces. Thank you so much for your service. With that, I want to go ahead. I want to dive in. I want to bring Professor Cochrane on to the broadcast. John, as always, it's great to have you. Love the prep call we had last week, and I'm fired up for the talk today.
Good. Glad to be here.
Good. Well, let's go ahead and let's dive into it. No shortage of things to cover. I want to start with government shutdown. And, you know, we're hearing right now that maybe some stuff is moving through Congress. Maybe they're going to figure some things out. But your perspective on the shutdown, its impact on the economy, its impact on growth, what do you think about what's going on there?
So far, its impact on politics and air travel. But I don't think this is going to have a big or long-lasting effect on the economy one way or the other. I would, if anybody's in the administration looking, you know, get ATC going again. You got the money. Don't cancel Thanksgiving or Americans are going to be really angry. Other than that, let's hope it gets over with quickly.
Well, I would agree with you on that because I got to hop on a flight and go to LA later today. So I hope that everything's as smooth as possible. But, you know, thinking more about discussions around Congress, things that are going on there, let's dive in. I want to talk a little bit about U.S. debt. We know what the level is. We know what's going on there. There's a lot of chatter. We're getting a lot of questions from financial professionals. What's your perspective on the level of U.S. debt, where we're at, and what the heck do we do with this thing?
Yeah, well, too much of it. And to your, a little more serious answer to your previous question, we are not talking in the budget shutdown about, you know, the great, how are we going to solve the U.S.'s fiscal problem? How are we going to fix healthcare and health insurance so that it's sustainable? You know, that's not what's going on. It was a plea for, you know, one more $100 billion subsidy from the Democrats that the Trump administration said no to, but that's not going to solve the problem. So debt, yeah, got 100% debt to GDP. Paying it off is not actually difficult if you go back to solid long-run growth and to small primary surpluses. That needs, and it's a thing for over decades. You don't have to do it right away, but you have to get back that confidence that we're going to slowly but surely pay back our debt. It needs a sensible reform of entitlements, sensible tax reform, stop throwing money down rat holes, and will they get to it sooner or later? The problem, though, is the spending. It's not the debt. Even if we inflated away all our debt tomorrow, we would still have this problem. Now who's going to lend us 5% of GDP for the next year? So it's that long-term spending that's the problem.
And when you think about the long-term spending, I mean, again, in your opinion, like where do we start with that?
Oh, well, you know, that's the problem with being a growth-oriented economist. You know, the Keynesians just say stimulus and, you know, throw everybody checks and it's easy. You know, reforming the U.S. government is like a Marie Kondo project on your house. So you got to, you know, reform the bits piece by piece. The big ones are, of course, the entitlements. We've made big promises to old people that we can't keep, and you don't have to be heartless about that. You know, can we fix the CPI adjustment that is currently a little bit over generous? Can we index the prices, not the wages? Can you remove the disincentives for people not to work and to overuse social programs? So that, you know, there's a fairly straightforward reform if anybody wants to sit down and do that. We'll see about that willingness.
Well, I think that's the real question, right? I mean, this is what you're discussing there. I don't think is really news to people. Really, the question is that how do we go forward with that? I'll say, especially when you've got relatively short terms for a lot of the members that are in there. I mean, it's one of the challenges that I see there. If you've got, lack of commitment for a lot of reasons to actually get this stuff under control. Would you agree with that?
Well, yeah, but that's been true for 250 years. And our government has in the past been able to sit down and do sensible reforms when they're needed and not in the middle of a crisis. So I hope, and I think bond markets hope. Let's get to what we're talking about here, right? When do the bond vigilantes come? I think bond markets look at this and say, this is a serious country. They've been able to do, the 1986 tax reform, the 1982 Social Security reform. They've been able to do things like that before. Surely, before a great debt crisis comes, they will do it again. Now, maybe our politics is so fractured we can't do simple reforms that other countries can do, even without, there's no external pressure. If this happens, it's a self-imposed wound of our inability to cure obvious problems of our own program. So I'm still hopeful, but in part I've been carrying around this world is ending debt crisis coming sign for about 20 years. It still hasn't happened. And I do worry about fragility. So if the next crisis comes, Uncle Sam wants to borrow another $5 trillion and hand it out and maybe rebuild the military or whatever is needed in the crisis. I don't know that bond markets are good for another $5 trillion, especially after the haircut they took last time due to inflation. So let's hope we don't face a crisis where we're unable to borrow. That would be a dangerous scenario.
Well, I think that's also one of the concerns that I hear a lot is that we look at where we're at in terms of we're not necessarily in a crisis and yet the debt is still high. How do we handle it if we do get something that actually pops up? And I guess a question for you, and you reference this, and I think it's a good data point, but is the bond market something that you're really looking at to say, this is where a lot of information about the true concern around the debt, around what's going on is out there? Is that a spot that you look to?
No. And it's really funny. I mean, I'm Mr. Efficient Markets, only second to Gene Fama in that one. But markets are efficient and they're not clairvoyant, and we should remember the difference between the two. Bond markets have never seen inflation coming, and they never saw inflation going away. In the 1970s, long-term rates did not rise ahead of the inflation, and long-term rates stayed high even as we were disinflating. Bond markets and CPI futures markets did not see the big inflation coming of 2020, 2021. That'll look pretty obvious to me. That's not usually a reliable signal of bad things to come, because a crisis is a crisis. We knew a crisis were going to happen tomorrow. We'd all get our money out today. It would happen already. So, that efficient markets insight that bad things will always be surprises is true in this case as well.
Well, let's talk a little bit about, we're talking about debt, we're talking about what's going on with spending, all the things that we just discussed here. A related question that came through was around US dollar. And I'll say value of US dollar, fall of US dollar, concern about it as a global reserve currency. What are you seeing with the US dollar, and what are you thinking about?
Well, as someone who has a taste for imported goods, I wish the dollar were stronger, and it has been falling. And we need to remember our DFA credentials and not get into, why do prices go up and down, because it's very hard to tell, and certainly nobody can forecast where they're going tomorrow with any great rationality. So, dollar ought to be stronger. If we do another bout of inflation relative to other countries, that it'll go down to some extent, that we can tell. The dollar as a reserve currency, I think, is a fact, but I think don't overdo what its advantages are. We are able to print up a certain amount of dollars, send them abroad. Foreigners are willing to send us stuff on boats in return. That's awfully nice of them. That is what it finances imports. That's what it does. Dollar as a reserve currency. It's nice to have a currency that everybody agrees on in the global transactions. But I think I'll quote Larry Summers. Actually had a very wise statement on this. In the state of the world where the dollar has ceased to be the reserve currency, so many disasters have happened that losing the dollar reserve currency is like 100 on your list compared to the horrible things that made that happen. And I think that's right.
Yeah, I think that's a really good way to to think about it in terms of all the things that maybe investors should be stressing about. Having that dollar fall as the global reserve currency, there's probably a lot of things that happen ahead of that. Hey, going back to the sort of spot where we're at on debt, on spending, on all that, interesting one came in here. Around taxes, and taxes are at historical lows, especially for wealthy and corporations. Some savings may be had from spending, but it seems we can make a much bigger dent in national debt by having a more fair taxation system. Gary, thank you for sending that question in. What are your thoughts there on where we're at in terms of tax rates and impact on both, I'll say both the debt as well as on growth?
Well, I would challenge the assertion that taxes are at historical lows. There wasn't even any income tax before 1913, so I don't know what your sense of history goes. You know, in 1986, the top federal tax rate was 28%. It's a lot more than that now. The all-in marginal tax rate, so take a high earner, earn an extra dollar. How much do you actually get to spend after federal, state, local, property, excise, all those other taxes, sales taxes? I figure that's about 70% now. So it's, you know, we have European levels of marginal taxes at the high end. Middle income Americans don't pay quite so much taxes as Europeans do. They finance middle income benefits with middle income taxes. Fair is a hard thing. I don't think that's an economic concept. I like taxes that don't distort economic activity. Raise the maximum revenue for the government without distorting economic activity. And there's a lot we could do to bring in more money, you know, without the huge distortions of the tax code and the hundreds of thousands of pages of scandalous exclusions, deductions, credits, and so forth that go in the tax code. You know, revenue, our government takes in overall at all levels about 45% of GDP. France takes in about 55 to 60. Is that not enough? Not obvious. I think in the long run, it's the spending that's the problem, not the level of taxation. But the inefficiency of taxation is a place where there we can all agree. We can get more money with less damage by having a much better designed tax system.
Yeah, I think everybody would probably agree with that. Hey, on the revenue side, you talked about other spots where we can be bringing money in. What are your thoughts on the revenue side and what we need to see there?
Well, they put me in charge. We throw out the income tax, throw out the estate tax, throw out the corporate tax, and put in one big value-added tax. It's the least distorting tax there is. Now, everybody kind of knows that, so to some extent you cobble together a tax code towards that direction. But there's so many political interests who want a credit for this and a deduction for that it's awfully hard on doing it marginally within the current system. Taxes are best done in like a 1986. You bring everybody around the table and say, okay, everybody, we're going to lower the marginal rates immensely, but you lose your loophole, you lose your loophole, you lose your loophole. But I want you all in on this. You know, don't start arguing you want your special credit back because we're all going to come out better in the end. I don't think we're at a political moment where that's likely, but that's what, you know, eventually responsible countries do.
Well, I would agree with you on that. I was about to go there, but we don't need to get into an overly political discussion here on the broadcast today. Interesting question here. If we do not get a signal from the bond market, what signals do you look for trouble in the economy? What are you looking at?
Oh, that's a good question. I'm kind of more a long-term guy, and I'm not an active investor. Every time I get this urge, let's go buy something or sell something, it turns out to be a disaster. So I'm always grateful that I didn't have that urge. You know, in the short run, timing of recessions is, you know, it's kind of interesting in the short run, but I think long-run growth is the issue of our times. If we had been growing for the last 20 years at the post-war average, rather than what we have been, that's an extra 2% a year. Well, that adds up after 20 years. You know, that's 40% more that we would have had from long-run growth. That's way more than recessions. So I think, you know, the issue for America is we got the regulations. You can't get we all sorts of good ideas, and you can't get the permits. You know, look at my land of California. We've been trying to build a high-speed train for 30 years. They have not laid a single mile of track. They've blown through $20 billion while they're at it. Good luck getting a permit to build a house. You know, that kind of problem excites me more than trying to spy a recession coming before the next guy. Because again, this is like trying to outwit the stock market. If we knew with scientific certainty there would be a recession next year, what do? Well, if you're a business, you start getting rid of your workers now. You start trying to get rid of needless inventory. You button down, and guess what? You got a recession right away. Also, recessions are almost always something financial going on. If there's just kind of slow times, even a pandemic, those things go away quickly if there isn't a run on a bank or a big bankruptcy thing. Well, if you could predict a run on the bank tomorrow, you'd go run on it today, it would happen today. So I think that my piece of wisdom here will be, don't try to listen to people like me and guess where the economy's going. Get your risk management intact so that the inevitable uncertainty doesn't surprise you. We got to admit to our viewers, my office was next door to Gene Fama's for 30 years, so there's a little influence there.
Well, did you influence him more, or he influenced you more?
Oh boy, influencing Gene Fama is a hard thing to credit. I have helped him on a couple things, and he has looked at me going, "What are you talking about, John?"
I'm sure they were great discussions. We're talking about looking at different signals, thinking about the economy, trouble that you look for there. Let's talk just a little bit about the data that's coming out around the economy. What's going on, what's released, how much trust can we put in? I mean, do you see anything that's taking place that gives you more, less concern about any of the data that's coming out or maybe not coming out that investors are looking at?
Yeah, so we have this problem that, the data collection for the government has been cut back a lot. Those are very useful statistics, and in the grand scheme, I wish our budget cutters could sort of get a sense of what's important and what isn't. Providing good data has been a wonderful thing the federal government has done for many years at incredibly low cost. So it would be nice to have more of that. I think both the government and investors ought to have a longer term view than, oh my gosh, what's the latest job report say? Do something, jump up and down. We're at the peak of a business school. Business cycle. We're also at the peak of a business school, but that's another story. There's this late fall, and we're all waiting for the snowstorm to come. Now, we've been waiting for that for a couple of years. I don't know how long people have been forecasting recession. And again, something financial has to go bad before it really turns into recession. But you're seeing, signs of weakness here and there. I wouldn't be surprised if it comes, but it needs a shock. Every recession needs something bad to happen to tip it off, and we haven't had the shock yet.
Let's shift gears just a little bit, because we got a ton of questions in about the Fed, what they're doing, where rates are at, too high, too low, should they bring rates down a little bit more? What do you see where the current Fed funds target rate is? And maybe relative to historical, do you think it's too high? Do you think it's too low? What are your thoughts on that?
Well, high versus low. I'm by nature sort of a hawk, especially when you got 3% inflation trundling along. I grew up in the 1970s. I remember that not taking that seriously was a disaster. Inflation's like cockroaches. Just because you're down to the last one or two doesn't mean you're done with it. So that's my inclinations. But who knows? Let's talk not about what I think, but which doesn't matter at all, but what's likely to happen here. The Fed is facing a stagflationary shock with tariffs and things like that. So, and the remaining 3% inflation that hasn't really squished out. So it's torn between holding rates high to try to really get rid of that last couple of cockroaches on inflation versus the political desire. Let's state it out loud. Trump wants lower interest rates. Not quite sure why he wants to create inflation for himself that it did in Biden, but he wants lower interest rates. That's his and his administration's judgment of the things to do. But so they're facing that political pressure. They're also trying to think about what to do with tariffs. So tariffs, I know you're going to ask about that, but I'll give the answer now because it's relevant. The tariffs are up. That's going to raise cost of imported goods. That has not all passed through yet. So I think we see a substantial rise in the price of imported goods coming ahead. The Fed is pretty much out loud saying we're going to do to that what we did in 2021, 2023. We're not going to react. We're going to let that one-time rise in the price level go through the economy. So I don't see them really aggressively trying to fight tariff inflation. But unless there's a recession, I don't see them aggressively lowering interest rates. So they'll do what they always do. They will react to employment, inflation, and political pressure. And I think that leads to, I'm not telling you anything new. They say we're going to leave it roughly where it is for now, and there's about as many hawks and doves fighting about that. So about where it is, probably maybe a little lower, and then we'll wait for something to happen. If the economy slips into a recession, watch for rates to go down in a hurry. If inflation breaks out and they're not able to say, oh, it's transitory, oh, it's tariffs, oh, it'll go away, then they'll raise rates, I think, a little faster than they did last time. They're not going to sit on their hands for a whole year. They understood that was a mistake. So that's my guesses.
Do you think they put themselves in a tough position? And if you look over the last couple of years, maybe what should they have done differently?
Well, they're always in a tough position. The Fed clearly mishandled the big inflation of 2021 to 2023. Now, it wasn't all their fault. And so my analysis of this, let me make sure people disagree. I think the fundamental source of the inflation was the massive fiscal stimulus. We literally handed out $5 trillion of checks. And Milton Friedman told you, hand out $5 trillion into people's bank accounts, they go spending at inflation. So that's going to happen. But the Fed was part of that. They bought up $3 trillion of that, so they monetized that debt quickly. They kind of mistook what was happening in COVID as lack of demand, whereas it wasn't lack of demand. People weren't failing to go out to dinner because they didn't have the money. The restaurants were closed. And then they kept interest rates low for a full year afterwards, and we can talk about why. And they haven't really faced up. This was a major mistake. If you're a central bank, your first mandate is inflation, and you have a 2% target, 10% is you need an after-action report. You need a what went wrong. And there's sort of, well, the dog ate my homework, supply shocks, I don't know what happened. Now, in today's Washington, can you expect an agency that is, very interested in its own institutional prestige to be honest about, we made a big mistake and we got to figure out what happened and not do it again? No, they're not doing that. But it's very clear, I think, if you didn't want that inflation, that they should have not monetized so much of the debt and moved much more quickly on interest rates. That the Treasury shouldn't have spent quite so much money if we didn't want inflation. But some people think the inflation was good, this way bondholders paid for it. I don't think so, but it's a valid argument.
You've done a lot of work. You've written a lot on inflation, thinking about price levels. I mean, with where we're at right now, maintaining good price stability, seeing what you see right now, like what are the correct steps that we should be thinking about?
Well, so I'm Mr. Fiscal Theory of the Price Level. Let me advertise my latest book. That's what academics always do, right? I think we're in great danger as long as this continuing fiscal deficit is there. And people's trust in government debt is much shakier than it used to be. Do we all trust, if they say we want to borrow another trillion or 2 trillion, that we will somehow raise taxes, cut spending to pay it back? I think that trust is evaporating, and that trust is fundamentally what keeps inflation in check. Plus, a commitment by the Fed that they're going to do their part, which means, but it's funny, they're not really willing to say that out loud. They say expectations are anchored, and I go, anchored by what? What are you going to do? Just give more speeches if inflation expectations go out? It has to be anchored by a stated willingness to, we're going to do what it takes, including raise interest rates hard if inflation comes back. And you don't really hear that from the Fed. So, inflation, it's like the stock market, right? It depends on faith, that the companies are well run and the earnings are there. And when that faith disappears in government debt and management, you get inflation that seems to come out of nowhere. And that's, I think, a worry.
Well, and Nathan typed in a question here, and he sort of started to answer this, but he wrote in, he said, if the U.S. government debt crisis occurs, what form do you think it'll take? Default, high inflation, as you referenced, Japan-style prolonged overhang-driven economic malaise, something else? I mean, a real positive comment there from Nathan, but get your take on that.
Well, I think Nathan's right, because the heart of risk management is to think of all the horrible things that can happen. Now, they may not be likely to happen, but you got to know what the scenarios are. So that's exactly. And of course, then there's the positive scenarios. Maybe AI will come and next year none of us has to work anymore. That would be nice too. Now, all of the above. So the U.S. has the opportunity to inflate its way out of debt, out of a debt crisis, rather than default. That, of course, will not make bondholders in a particularly good mood to keep lending us money. The big problem is that structural deficit. If the U.S. were running structural surpluses, then everybody would know we're good for it. We could borrow lots and lots of money without any problem. So that's the underlying problem. Now, what happens if you have structural deficits you're unable to fix? Well, then we become Latin America, the pre-Malay Argentina, and a little bit of all of the above. So endemic inflation is one answer. Don't rule out default. Now, it's never default in terms of we're not paying. It's restructuring. It's financial repression. It's holding down interest rates, forcing banks to hold government bonds, maybe even at worst, a conversion. Well, you can't really cash in your treasuries. You got to turn them in for artificially low interest rate long-term bonds. That kind of stuff happens. Wealth taxes come. Stagnation, financial repression, high taxes, that's all things that happen when governments can't get around to paying their bills. Even explicit default. When the last debt to ceiling, you just saw what happened. Government closed down for a month and a half. When the last debt ceiling crisis hit, both the Treasury Secretary and the Fed were not utterly clear about we're going to pay interest principal before we pay Social Security checks. So a technical default, which would be a financial calamity, is more possible, I think, than people say. But we're into the left tail of the probability distribution, worrying about things.
I guess the question is that if all of this information is known, what we're talking about right here, investors know this. We're talking about the U.S. debt. We're talking about the fiscal deficit, the problems with what's going on. Why are we not seeing rates on treasuries to borrow more money from people go up? We've obviously seen them increase. Don't get me wrong.
I'm not holding 30. Okay, only piece of investment advice we'll talk about. I'm not holding 30-year nominal treasuries. I don't know if you are. And we're noticing the Treasury has started issuing shorter and shorter because they realize the limited appetite for long-term debt. So to some extent, those long-term bond prices are being held down by the Fed buying a lot of them, by the Treasury not issuing a lot of them. I see sort of technical signs of weakness in that long-term Treasury market. But, it's not a guarantee. So these are risks, but they're not the central tendency. I still have hope that soon, as they always say of America, we'll do the right thing after we've tried everything else. The right thing is fairly clear what you have to do here. So, please don't let a debt crisis spill out. Please, dear Congress, it's not that hard.
You had mentioned AI briefly in one of your previous comments. We got a bunch of questions in on that. With the current state of AI, gains on efficiency, and yet you have layoffs that are taking place with companies, how do you think about that in terms of where it's at and maybe how that plays out over the next couple of years?
Well, I'm an optimist. I think this is great. My entire professional career, which started in the 1980s, we've been worried about slowing down growth because apparently either we're out of ideas or we can't get the permits. That's been the argument in the economics profession. And here's a beautiful new idea that has the promise for a great rise in productivity. What does that do? Well, this time is not different. We've been at this over and over again since the invention of the steam engine and the mechanical loom, and the automobiles took over, and the buggy whip manufacturers and horse riders were out of business. When office back in the 70s, offices used to be filled with people typing, and now we have word processors and Xerox machines. So, over and over again, we have productivity enhancing investments, innovations that make some jobs obsolete, but make other people much, much more productive with what they do. And if that were going to be a job killer, we wouldn't be sitting at a 4% unemployment rate right now. So, people with specialized skills are going to have to find new jobs. That won't be pleasant, but it's a fantastic opportunity for the economy. I don't think it's going to come as fast as the optimists say. Every other invention has taken a long time from being the snazzy new thing to being deployed at scale and then being actually useful in productivity. This one may happen a bit faster because you can get it onto your computer faster than you can get airplanes built and out there and flying. But we all have to learn how to use AI. That's the big, how do businesses use AI to do things that are valuable better, and that's going to take some time. So I'm an optimist. I don't think it's going to be as fast as the optimists say, nor as disruptive as the pessimists say, but it will disrupt a little bit. It's the way of life.
Well, it's a good point. I mean, I think we've always seen those disruptions take place in the economy, take place in the workforce. People have to figure it out going forward. When you look at the sort of current makeup of U.S. population, U.S. workforce, do you see anything there structurally that has changed dramatically? What should be on the horizon? I mean, what are your thoughts on that? And I'll say, what are your thoughts on that in terms of the U.S. relative to other countries around the world?
That's a big one. We have a crisis of our educational system, which is, barely producing people who can read. I mean, you're worried about people using AI. On the other hand, we might be reversing the big trend of the 1980s when, that was when the skill premium rose and everybody said, oh, inequality is terrible. Well, now those sort of semi-skilled mid-management jobs are being driven up by AI, and plumbers and electricians might be the ones who do the best in the future. As some tasks get done by AI, the ones that can't get done by AI become more and more valuable. So we may see, all the people worried about income equality may get what they ask for, which is much less, less premium for people with soft college degrees, and more premium for people who do stuff that AI can't do. Relative to other countries, the U.S. is remarkable for how quickly we're still able to do things. We're pivoting into AI data centers faster. I mean, Europe, you can't even get the permits to even think about one yet. The U.S. is still a great place for moving quickly on that kind of innovation.
Do you think that's why you still see a lot of, I'll say, investment in the U.S., reasonably strong economic? I mean, we've got our issues, but when you look at relative to what's going on in other spots, we still look pretty good. Is that a fair statement?
Absolutely. We go round, everything's terrible in the U.S., and then go to Europe, where growth stopped in 2010. I mean, just stopped, which is, a real tragedy. I love Europe. They should be growing. Well, it's not hard to see why they just stopped. Look at European Directive number 325-B4, which stops you from doing anything before you get the permits. China's, rolling ahead, but remember, they're still way poor compared to us, and they have their own problems. So the U.S. is still, we are still growing, and that's great. Things could be better always in the U.S., but I don't think anyone we don't want to trade with anyone right now, that's for sure.
I guess the question then is that, with all the things we're talking about around issues around debt, deficits, inflation, role of the Fed, all of those things, what do you see for the U.S. going forward, and what are the biggest risks in your opinion?
Well, so there is an AI risk, and this is financial. This is widely discussed, so it's not a deep insight, but a repetition of the late 1990s is possible. There's a lot of investment in data centers, which sort of looks like fiber optic cable of the 1990s. The stock market valuations are incredibly high for some of these companies. Clearly, not everyone is going to be there. The creative destruction will, as they said of the internet in the late 1990s, it's over. Netscape, Yahoo, AOL, Time Warner, they got this thing all wrapped up. So much for that. So some sort of shakeout is likely to happen. But, after the shakeout, of course, you got this wonderful thing going. I'm focused on the long run, and the thing that bugs me about the U.S. economy is stagnation, crony capitalism, call it what you want. Big companies, too politicized, not the kind of nimble free market economy that we like to think of the U.S. And that has long run consequences, but it's not a recession next year kind of thing.
Do you think that's changed dramatically in the last couple of years?
No. It's a creeping issue of both parties. They like to get big businesses to come do what they want in return for favors. Your compliance department is still pretty big. There's been a lot of under the radar screen deregulation going on in this administration, which I think is very hopeful. First day, we are not going to commit energy suicide like Europe did. We're not going to commit AI suicide like Europe did. So even just stopping the regulatory juggernaut from ever larger expansion was a good thing. So there's lots of hopeful signs out there.
Let's talk a little bit about gold. And I'll say, I mean, the questions that I'm getting around gold are sort of one, as an investment, two, as a flight to safety. Obviously, we've seen dramatic price appreciation with gold. When you look out there and what you're seeing with gold on the global markets, what's your take on it?
Well, I don't think I have anything unconventional to say about it. It is, of course, it's a flight to safety asset that a small minority of investors like to jump into when they're worried about things. It has no fundamental value, so as a long-run investment, it doesn't seem to me like a great idea. So I think of it as an option price. It's a sign that the dispersion of beliefs is getting bigger, and people whose investment strategy is what they used to, I think they said correctly of Ron Paul, was his investment was guns, beans, and bars of gold. So people who worry about that sort of thing occasionally drive up the price of gold, which is, I think, to some extent what's happening now. But I don't know that it historically is much of a useful forecaster of anything.
Yeah, actually, I think dimensional. I think we just came out on a piece with that around gold, and yeah, you're right. We've seen tremendous volatility in the price of it over time, and also long strings where you can have negative annualized returns for quite a while. John, I'm going to go completely off script here, and this question really did come in. Who is the artist of those amazing pictures behind you? And we actually had this conversation on the prep call. So can you tell the audience, because we got a question on it.
These are from Sally Fama Cochrane, my daughter, sallyfamacochrane.com. You can go see and look her up on Instagram. I don't have it handy. And she does wonderful art, and this is all hers. They're representational, but they all have scientific themes, so I won't give you an art tour right now. But fortunately, she was moving around, so our walls are filled with artwork right now.
I love it. We did actually get that question in, but I told you I was going to get a shameless plug-in for your daughter around the picture. A couple other questions that came in. I'm going to circle back to some of the topics we talked about a little bit. Walter wrote in, what could happen if the Supreme Court says tariffs are illegal? Let's go to the tariff conversation for a little bit.
Yeah, so tariffs, that is kind of the big news. So what they will likely say is that the emergency authority was illegal. Whether they will make the administration give back all the money is an interesting question. I'm betting that they won't. That will be difficult. Unfortunately, the tariff law is already written so loosely that the president has the authority to raise tariffs on a whole bunch of other bases. So he'll just have to do a little more paperwork, and then he can get tariffs. He won't be able to use them as much as a day-by-day cudgel, but if he wants high tariffs, unfortunately, he'll still be able to get structurally high tariffs. I mean, Congress is supposed to set tariffs and used to set tariffs. They're taxes, and it was Congress. But then they gradually devolved authority, real legal authority, not just this emergency authority, to the president. And the basis is, they just have to find some harm to American industry. Well, some industry has to come in and say, hey, we're harmed, and then they can get some tariffs. So it does not mean the end of all tariffs and back to 19th century free trade, even if the administration loses.
Let's talk a little bit about cryptocurrencies, because digital currencies, we're getting a lot of questions, about that. When you look over the last couple of years, you think about the landscape for cryptocurrencies. I mean, what is your take on it? What do you see are concerns? What do you think are potentials? What are you excited about?
Crypto. Well, so there's Bitcoin, unbacked crypto, which is very volatile. It's the modern version of gold. And obviously a fun speculative investment, but sort of like bad modern art, not good representational art, but bad modern, gold and other things like that. You can have fun with it. Also useful, for illegal transactions, and we'll see how long governments let you do that. The Europeans seem like they're about to completely crack down. Then there's stable coins, which is a different kind of crypto. A stable coin just implements a money market fund, and we all understand how a money market fund works. It can implement it in very useful ways. It gets around a lot of regulation. One thing I see is stable coins being used as ways to get around like the Fed, which scandalously won't allow narrow banks to emerge. Well, a stable coin is a narrow bank. In some sense, by wrapping it in some technology, you can do that and get back to where we should be, which is large-scale uninsured deposits that are completely backed by government securities. Well, you can implement that with a stable coin. The exciting part is also the ability to add conditions to it. So a stablecoin transaction can be arranged to be the escrow agent as well as just the transaction. So that I think is, so there's a lot of financial plumbing which is going on with stablecoins. So there's three ideas, and you can ask me some more, and I'll have crusty answers.
Let's hear some more. Let's hear some more of those. I mean, your nickname is the Grumpy Economist. Let's hear some more crusty answers on this.
Well, there is a big issue here, which is to what extent do we get to transact anonymously? So some of crypto has been used to avoid good regulations, like people got to pay taxes, but also I'm not that interested in forcing China's currency controls, and so crypto's been useful for that. Now, that's a big question our governments are going to have to face. Where's the borderline between anonymity, freedom to transact, and on the other hand, if the government can watch everything you buy, that's a really dangerous place to be.
Interesting question came in here. What's one risk that you believe is currently being overlooked? It says by advisors and their clients. I'll just say whether it's financial professionals, investors, like what is one risk that you think people are failing to sort of take into account in the current environment?
There's always, I'm Mr. Government Debt, so the possibility of a large-scale sovereign debt crisis around the globe, I think, is one that people don't pay enough attention to, and not, yes, so we're starting to pay attention. You were able to ask the question on the show, what about a U.S. sovereign debt crisis? It could happen. Anything that's happened in Argentina could happen here. It could happen in China. It could happen in Europe. A sort of a bondholder revolt. Where does a crisis come from? It comes from money that's been borrowed that nobody knows how it's going to get paid back, shady accounting, rolling over short-term debt, and a spark. And that sort of describes sovereign debt. And it would be a calamity, since so much of our financial system is built on the sanctity of short-term U.S. debt and built on the willingness of the U.S. government to bail everybody out in bad times. We have a very fragile, over-leveraged, risky financial system because everyone's got used to not only will the Fed bail you out, but as in 2020, they said whatever it takes to keep corporate bond prices from falling. So if you keep some cash around ready to buy on the dips, well, you've just been front-run by the Fed. You learned your lesson. So there's a lot of financial fragility out there. So those are two things that I think are, keep me up a little bit at night. Major
sovereign debt crisis. I mean, how does that I don't want to be too doomsday or anything like that, but like, how does that play out? What does that look like? I mean, what are your thoughts if we go down that path?
Well, I don't want to spend too much time on that because we've already spent some time on it. But when bondholders say we don't want to hold large amounts of government debt, and they might first run from China, and then they might decide that the euro is no good, and then they might decide they want corporate bonds, not U.S. government bonds. And it's true we can't all hold Swiss francs, but we can all try to, and that would be a concern. Anything like that needs a spark. So I might say, how will our financial system handle the next crisis? There will be a crisis, right? We had once-in-a-century financial crisis. And then 10 years later, we had the once-in-a-century pandemic, which turned into another financial crisis with massive bailout everywhere. So another one will come, and it could be geopolitical. What happens when China invades Taiwan? To financial markets, to global trade, governments will certainly want to be borrowing tons and tons of money. Will that money be available? So bad things can happen. I guess that's a truism, but I think we're fragile to that kind of event.
John, I love how when you're talking about a global market meltdown, you have the biggest smile on your face when you say it. We talked a little bit about equity markets. We talked about the bond markets. Walter typed in here, any concerns about what we're seeing in the derivatives market?
Oh, what are you seeing in the derivatives market? I don't do derivatives. Long only rebalance once every 20 years. What's going on in derivatives markets?
Well, I guess it's a question there of like if we're looking at different markets and we see any types of structural concerns, risks in terms of prices, anything that you see there. But I think you kind of answered that. So Walter,
but I will say it's a good place to look for. So think of a probability distribution. The probability distribution can move to the left or the right. People can say, oh, X is more likely to happen, but it can also widen out. So people say, oh, there's just too much, there's a lot more risk. And you see that in derivatives markets where implied volatilities of the VIX or the inflation derivatives, that you say, well, what's the chance of inflation going up to 10%? Those things go up. So those are good places, warning signs to look when there's times of uncertainty coming along. I think I've said the obvious, but sometimes the obvious is worth restating.
No, I think it's. I mean, look, we're just talking about other market prices, and market prices contain information. So, Walter, appreciate the question there. Hey, let's flip it around. Let's talk a little bit about positive. David typed this in, which I thought was good. You're talking a little bit about doom and gloom here, but
yeah, thank you. We need good stuff.
So, what are some economic advancements that you've seen recently that give you excitement moving forward? I mean, I think, overall, certainly here at Dimensional, I think a lot of the people on the call here are optimistic people. So, what is it that you're observing out there that gives you an optimistic view?
Well, again, I'm on the sort of the long run end of things. So the existence of AI, I think, is wonderful. I think it's going to be not so much the ChatGPT X that's going to be driving it, but what we're seeing now, kind of under the cover, is companies rolling out AI applications for businesses. How does AI help you to, sell paintings or whatever you're doing? That will lead to a great expansion in American business. So that's, again, it's an obvious thing that's worth saying. I do see a sense for a general understanding that we've kind of overregulated ourselves and tied ourselves in knots, and we need to do something about it. And I live in California, so I see that among progressive Democrats who discovered, it takes 10 years to hook up the windmills to the electricity grid. How are we going to save the planet? And then they discovered, house prices are horrendously expensive here, and nobody of middle income can afford to live here. Gee, maybe we better let them build houses. So that kind of realization is slowly sinking in on all sides of the political spectrum. Maybe I'm being, Pollyanna and just looking at the things that I like. But I do see that sense. We may be in a chaotic period, but chaotic periods are times when you can break out of stagnation. And so there's a lot of breaking things going on, and some of it's great, and some of it was just breaking things that have been sitting around dysfunctional for 30 years. And that gives a chance to build up something better. So in a general point, volatility can be really good.
Yeah, I would agree with you on that. It creates opportunity.
You get a chance to pick the good parts out of volatility.
Yeah, it creates opportunity for people to step up and figure out some of these problems. I mean, that rolling back of regulations, do you think that's one of the biggest things that we could get our hands around to really improve growth and get us to a better spot?
Absolutely. I think that's the number one problem. And it's so pernicious because it's very hard to quantify. You can quantify budget deficits, you can quantify debt, you can quantify tax rates. But just the effect of how hard it is to get something done and how much the implicit costs rise. I mean, you can get some numbers on it. It costs 3 times as much to put in a solar panel in California as it does in Australia. Why is that? Well, the tariffs, of course, but then, where I live, you got to get a permit, and you got to go back 3 times to get the permit approved, and you got to get construction drawings and stuff. In Australia, just got a solar panel, bolt it into your roof, plug it in, mate. So those things are hard to measure, but I think there's a growing realization. A little bit of competition with China might not be a bad thing. America tends to, when we're fat, dumb, and happy, we tend to start regulating things and fighting with ourselves. But a little Sputnik moment might get America moving to say, we got to do what we got to do. Cut through some of the regulations. Even there, people say, we got to cut through the regulations to connect the windmills to the grid. Well, then why are those regulations really important for, connecting other things to the grid? And that realization's coming. So I'm optimistic, but we're heading too much into politics.
Well, that's all right. Just, on the China question there, when you say a good little competition with China is a good thing, I mean, what do you mean by that? And just expand on that a little bit.
I just meant that from a sort of a political mindset point of view. It's tempting to sink into we've got to protect this and keep the old ways going, and stop those terrible Uber people from taking away our taxi driver jobs kind of thought. But when China's building stuff at amazing speed and building aircraft carriers and really doing amazing things with manufacturing, it kind of holds your feet to the fire that you have to allow some of that creative destruction in the U.S. too.
A couple of questions. In fact, 3 just came in here right away, and we get a lot of questions about this. But you're seeing, I'll say, broader interest from a larger group of investors around private investments, private credit, private equity, private infrastructure. And we get a lot of questions about it. I'd love to sort of hear, because you obviously believe deeply in public markets. When you move from public markets to private markets, what do you think about? What jumps out to you?
Yeah, a bunch of thoughts. So public markets are, of course, highly regulated markets. So, after Sarbanes-Oxley passed, the number of listed firms started collapsing because the amount of, as we were talking about regulation, the SEC and the Fed and the rest of them have vastly overdone what it takes to keep markets efficient and reasonably fair. So part of private markets is just like what I said about Bitcoin. Sometimes you use a worse technology to avoid the regulation. So that would be a sad point of private markets. Then another part of private markets is that they, Cliff Asness calls it volatility laundering. It's useful for big endowments not to mark things to market every year and to be able to make up what the prices are and not make it really clear just how much beta and how much volatility you have. So that's an illiquidity premium rather than a liquidity premium. And there's, corporate governance issues. Sometimes a private company funded by a large pool of investors can move more quickly and do things faster than a public company. So there's good and bad to everything, and there's reasons to things that are sometimes good and sometimes avoiding regulations, which is too bad.
Yeah, no, I would agree with you. I think that's in line with a lot of the comments that we make here at Dimensional. John, we're coming up close to the top of the hour, but just as you think about all of the people that are tuning into this broadcast, I mean, what should kind of be on their radar as you look towards next year, things that they should be talking to investors about? And I know you're a long-term guy in terms of what we're thinking about there, but obviously the financial professional needs to be, what should they be looking for in 2026 and what should be on their radar?
You don't want to be reacting quickly to events. You want a strategy that you understand, and if you bought into like value, we're buying stuff at low prices that are fundamentally good companies. If those prices go down even further, that means it's a buying opportunity, not a get rid of it now opportunity. If you bought long-term bonds because you understand long-term bonds give you a guaranteed income, then if interest rates go up and the bond prices go down, that doesn't mean it's time to sell. That means that those got even better deals. So stick with your long-run strategies and don't jump too much on the news of the day is, of course, the number one thing I would say. But on the other hand, investment's about opportunities and about finding things that other people haven't yet found. We are full of opportunities. And that's one of the things that the private thing does is it makes it harder for sort of passive investors. And you have to work hard to understand what are the good private opportunities, what are the bad opportunities. And you can always stay away, even with inefficient markets, you can stay away from ludicrously overpriced stuff.
John, I love it. It's always good to get your perspective, always an honest perspective, direct perspective, and I absolutely love the insight. So thanks for taking some time to join us here on the broadcast today.
Thank you very much, and thanks everybody for your really challenging questions.
Love it. Great discussion. Thanks everybody for taking a little bit of time to tune in. Thanks to all the questions. We got to as many as we could. Appreciate the engagement. If we didn't get to everything, we'll make sure that we follow up. We're going to get this thing posted as a recording as soon as possible. So check that out on the My Dimensional site. I believe we're also going to put it up on Dimensional's YouTube channel. So be on the lookout for that. For those of you that want CE credit, make sure you stay on to the broadcast. Short little quiz, answer those questions. We'll get it processed as fast as possible. Jake DeKinder, Head of Client Communications at Dimensional. Thank you all so much for tuning in today, and have a great rest of the day.